Most people believe that when you deposit $1,000 in your bank, it sits in a bank vault waiting for you. It doesn't. If every person in your city tried to withdraw their cash tomorrow, your local bank and the entire system would collapse. Because the money you see in your app doesn't actually exist as physical currency. Today, this video deconstructs the engine of global finance, fractional reserve banking. Conventional wisdom says banks lend out your savings, but the reality is far more provocative. In the modern world, banks don't just move money, they create it. By the end of this video, you'll understand the money multiplier effect and why the traditional reserve rules you might have heard of are being replaced by a much more complex global standard. This is the hidden architecture of the global economy. Fractional reserve banking is a universal system, where commercial banks hold only a tiny fraction of their deposits in reserve, lending the rest to fuel the economy. Historically, many textbooks describe a simple reserve ratio system. For example, a 10% rule where if you deposit $100, the bank keeps $10 and lends $90. In reality, the way reserves work is different in each country, and in some modern systems, like the United States, the formal reserve requirement for many deposits is now effectively 0%. This is where the math becomes transformative. When a bank issues a loan, they don't necessarily wait for someone else to deposit that exact cash first. Instead, they credit the borrower's account with a digital balance. In essence, they type the money into existence. Think about it. If you deposit $10,000, and the bank uses its credit-creating power to lend $10,000 to a business for new equipment, and that business pays a supplier who then deposits that money into their bank, the money supply has effectively doubled. Your $10,000 still shows in your account, and the supplier now has $10,000 in theirs. This is the money multiplier. It isn't a glitch. It's a deliberate global design to ensure capital is always moving. Without this constant creation of digital credit, global trade and development would grind to a halt. If banks can create money through lending, what stops them from going infinite? The answer is risk. The system's existential threat is the bank run. If public trust evaporates, whether in London, Mumbai, or Sao Paulo, and everyone demands their physical cash simultaneously, the bank fails. Because that physical cash simply doesn't exist in the necessary volume. To prevent a total systemic meltdown, every modern nation utilizes a central bank. These institutions act as the lender of last resort. They provide emergency liquidity to commercial banks during panics to keep the gears of society turning. It's a high-stakes global balancing act, creating enough credit to fuel growth, while maintaining enough trust to prevent a collapse. In most developed nations, only about 3% to 5% of the money supply exists as physical notes and coins. The rest is digital trust. Understanding fractional reserve banking is understanding that our global civilization is built not on gold, but on the movement of debt. Now that you know banks literally create money out of thin air, how does this change the way you look at personal finance, debt, and your long-term investments? Share your thoughts below.